Welcome to Berdon eCast. I'm MAURY GOLBERT, tax partner here at Berdon LLP. With us today is special guest Robert Knakal of Massey Knakal Real Estate Services. Bob, welcome to the broadcast.
Hi, MAURY. Pleasure to be here.
Massey Knakal, for those of you who don't know, is probably the leading sales broker and advisor in New York City real estate. Is that
on the building sales front? That's correct, yes.
So Robert has a sort of unique perspective on what's going on in the marketplace, kind of a pulse of what's happening. And they actually cover the city in a pretty unique geographical way, pretty much pinpointing a lot of different areas with some heavy analysis. So maybe you could spend a few minutes, Robert, just telling us what you think the state of the market is right now and where it's going.
Well, it's very interesting right now. I think that actually, as we all know, volume of sales fell off the table in 2009. We had a situation where in 2007 there were over 5,500 properties sold in New York City. That number fell to only 1,439 in 2009. In terms of dollar volume of sales, we went from $63 billion in 2007 to only $6.2 billion last year, so that was a 91% reduction in the dollar volume of sales. So clearly we've had a volume situation that has been absolutely abysmal. But fortunately that is trending upward. Thus far in 2010, we've seen an increase in the volume of sales over last year, and we've also seen prices surprisingly rebound to the point that we believe that the market is actually in a mini bubble right now at the bottom of this cycle. And that's being catalyzed mainly by what is an extremely acute supply-demand imbalance. The demand is excessive today. Really when we started to feel the effects of the credit crisis in a tangible way in the summer of 2007, the institutional capital that inflated that asset bubble
disappeared
from 2005 to 2007. That capital evaporated from the market. And so the overwhelming majority of transactions that we closed from the summer of 2007 until recently has been with high net worth individuals and the old line New York families that have been investing here for decades. And now we've seen a resurgence of that institutional capital because those funds have formed distressed asset buying platforms or opportunity funds. They're back in the marketplace, and in addition, we have foreign-based high net worth individuals that have returned to the market in numbers we haven't seen since the mid-'80s. So we have demand drivers that are in overdrive right now, and there is very, very little supply of available properties. And that has mainly been caused by the fact that typically the stock of available properties for sale is fed by discretionary sellers. Whenever you have prices fall, as we saw in 2008 and 2009, discretionary sellers withdraw from the market, and they're normally replaced by distressed sellers. But everything that's happened from a regulatory perspective has allowed distressed sellers to not have to deal with their problems. So we have a situation where we have very, very low supply, very high demand, and that's creating a situation where I believe today prices are higher than economic fundamentals dictate they should be.